Sometimes in life, we humans repeatedly make the same mistakes. In financial markets, it's no different. I'm Scott Connor, a 30-year veteran trader, and today you'll learn about avoiding common investing pitfalls right here on Virtual Trade. Welcome to Virtual Trade. In this episode, we're going to cover some of the most common mistakes investors can make. We'll then learn to navigate investing pitfalls via the Thinkorswim platform. And finally, new trader Jenny Horne and I will discuss how to potentially protect her portfolio. Sometimes investors make mistakes. After all, nobody's perfect. Unfortunately, mistakes in the investing world can result in financial losses. When losing money on a trade, a small one-time setback is easier to recover from than, let's say, several large recurring losses. Furthermore, these large losses can prevent you from meeting your financial goals. In many instances, however, losses are the result of investing mistakes that could have been avoided. Falling in love with stocks or companies can drain you of your finances, something like falling in love with vintage cars. Take that old 1970s Volkswagen Beetle I see every now and then on the freeway. Looks like it must have cost a pile of money to keep it on the road, but the owner's willing to keep forking that money out. In this case, the nostalgia factor is overriding the prudent expenditure or investment of capital. This might even offer the Beetle owner a positive risk to reward in their own mind, but that shouldn't be the case with stocks. We want to avoid emotional attachment or falling in love with stocks. Moreover, the primary consideration should be what that stock may do to compensate us financially. Now, let's take a closer look at a couple common investing pitfalls.
The first pitfall is falling in love with a single stock. This might sound funny, but some stocks form a cult-like following after a prolonged uptrend or as a result of a popular product or service. The financial media often feeds into a stock frenzy by frequently highlighting price gains or touting a company's product or service. All this attention pushes the stock price higher. But during the frenzy, some investors lose sight of risk management. Inevitably, the uptrend will end and the stock will reverse direction and head down. When the downtrend begins, these investors can experience massive losses. The second pitfall investors commonly find themselves in is owning too much of a single stock through an employer-sponsored stock purchase plan or through employer-issued stock options. If part of your compensation is company stock, then it can be easy to accumulate a large, concentrated stock position. However, this can increase the risk in a portfolio and lead to large losses if the employer stock trends lower. Before we move on to the final pitfall, let's discuss how you can possibly avoid making these two common mistakes. The solution is the same for both. Basically, it comes down to investing an appropriate amount in a single stock. Whether it's a stock you love or your employer stock, it's important to maintain balance in your portfolio. A key is position sizing. This is the process of spreading a portfolio equally among individual stocks and occasionally rebalancing overweight positions. Rebalancing involves taking partial profits in a stock that's performed particularly well and then using the proceeds to reinvest in another stock. This way, you can still consider owning stock you love or your employer stock, but you also help reduce the risk to your portfolio by maintaining appropriately sized positions.
So to recap, becoming emotionally attached or falling in love with a stock can be a common investing pitfall. Owning too much of your employer's stock may also be risky. To combat these pitfalls, carefully manage the number of shares you own of each stock. Now, let's take a look at another common investing pitfall: setting unrealistic expectations.
Sometimes investors start trading with the unrealistic expectation of making extraordinary returns, like 50 or even 100% per year. The truth is, these types of returns are very difficult to achieve consistently, if not impossible. Setting such unrealistic expectations can open the door to excessive risk-taking. Some investors might try to reach these unrealistic expectations by using a complex trading system without fully understanding how the system works. This can lead to unnecessary losses. Another way investors fall into this trap is by acting on tips and rumors from friends, financial media, and the internet. Trading on tips alone usually leads to losses for most investors. Investors can help stay grounded by having realistic expectations. For example, Stocks have generally returned high single digits per year, such as 6 or 7%. But these returns are not guaranteed. Stocks can lose money in any given year. Another way to try to avoid setting unrealistic expectations is to create and follow an investing plan. An investing plan defines entry and exit rules and other factors that guide investment decisions. It's much easier to be disciplined when you have an investing plan in place. You're less likely to rely on complex strategies, tips, and rumors. Following a plan that helps you steer clear of these common investor pitfalls might help you avoid large losses and keep your financial goals on target.
As we wrap up, it's important to remember avoiding common investing pitfalls can help you better manage your portfolio. Some of the most common pitfalls include falling in love with a stock, owning too much of your employer's stock, or having unrealistic expectations of market returns. To manage the risk associated with these pitfalls, it's important to carefully manage the number of shares that you purchase. Welcome back. It's time for Tools of the Trade, where each day we look at various tools within TD Ameritrade, Thinkorswim, and Mobile Trader. In this segment, we'll use the Thinkorswim platform to better understand potential investing pitfalls. Now, our takeaways today is we want to understand the emotional impact of losses and gains and how that psyche can play into long-term investing. And of course, we'll be using the Thinkorswim platform to get more familiar with how it works. So in our example today, we're going to start off by going to the chart and putting in a stock that many of you may remember had one of the very similar moves that many stocks did back in the what we call the tech bubble back around the year 2000. So let's jump into the Thinkorswim platform, and I'll go straight to the charts. And let's put in, the company we're going to use is going to be Real Networks. And again, if we don't know the name of a company, just start typing it in, R-E-A-L, and then the word networks, and there it is. I didn't even finish, and you can see right there is Real Networks. Just click on that, and of course now we're looking at the chart itself. I'm going to go ahead and hide the left side bar so we can expand our chart and then take a little bit closer look to it. Now, right now we're looking at a 1-year daily chart, but we're going to expand this out to a maximum time frame so we can go back many years and see exactly what happened to this particular stock, as did many stocks during the tech bubble back in 2000. So how do we do that? Well, again, let's go straight to the word D, or date. That's a good time frame. We're going to jump in there and go from daily and change our time interval not to just 5 or 10 years. Let's go to the maximum available. So I'll click on maximum available. And since we're going back a considerable amount of time, we're going to want to be able to see the whole chart on one screen. So let's not do 1 day at a time. Let's do something like a week at a time or a month at a time, since we're going back potentially so far in time. So let's start off by going to a week and see if that all fits on. I'll click week. All right, so maximum available. Look at each candle, if you will represent 1 week's worth of time. And sure enough, there, it's going all the way back to 1998. That's perfect. All right, so let's take a quick look at what happened here. We had the internet bubble in the late 90s, and many of the startup companies, like Real Networks, increased exponentially from all the hype that was going on in sort of the early years of the internet, the debut of the internet. So what had happened, as you can see on the chart here, reality set in, and many of these stocks came right back down to earth. So let's take a look at Real Networks on the chart and kind of go through what it experienced, because before the bubble crashed, the stock rallied almost 2,100%. Now, this wasn't unusual at the time. A lot of stocks that were in the internet space were experiencing this same move. So as a matter of fact, let's go back to 1998. Through 2001 or 2, and I'll just highlight that by left click and drag, and as soon as I let go, you can see it highlights that portion and blows it up on our screen. So you can see here, this is the year 1999 here, and this is the year 2000 here. You can see the exponential run that many of these stocks were on at that period of time. And look where Real Networks was. It was trading in the 6s or 7s and ran all the way up almost to $100 in early 2000. So that just gives you an idea of what was going on. Now again, this was not just Real Networks. There's hundreds, if not thousands, of examples of companies that were experiencing this same kind of move. And most of it, again, based on what? On hope or the hype of what potentially these companies can do. They didn't really show the earnings or the revenue growth. It was all an expectation. So that's what basically was behind this this bubble. So let's take a quick look at how this stock moved up. And remember, Real Networks was one that had a good move because it was one of the first internet audio streaming solutions that came to the forefront in around 1995. So let's think about the terms of what it was like to be a Real Networks investor. Now, of course, at this point, they felt elated about their positions, right? Very good about their positions. But sadly, many of those investors with those huge gains let their emotions sort of take over as the stocks began to fall. Now, this is a fairly common phenomenon that we want to address, and this falls into that potential pitfall category. So let's dig in here and take the experience of what many traders or investors went through at that period of time and see if we can learn from that. Let's take a quick look at what happened to the stock. Well, you can see that starting in 2000, probably about the first month or two after that, some of the stocks started to sell off. And then, of course, then those losses accelerated. There was a little bit of a climb out to about, April, May, June, somewhere in that time. And then, of course, by the end of that year, 2000, we were where? We were right back to where it all started before 1999 and 2000. So you can see there was quite a drop there. Now, many investors have described this grind down in sort of three different steps. And let's kind of talk about how they rationalized or sort of looked at this move. And what we're going to do is say, let's take the experience from this and help us add this to perhaps finding a way that we can avoid these kinds of pitfalls and make that part of our potential plan or our portfolio management. First, a lot of these traders, as they went through, they felt they had made the money on the stock. So in other words, when the stock was moving up in 1999 and early 2000, many investors thought, okay, well, I've already made this money, it's great, I don't have to worry about it or watch it. But remember, when you're seeing, once you purchase a stock and it moves up, that's great. But their gains are paper gains, or what we call unrealized gains. Those gains are not realized. In other words, the money's not in the bank, so to speak, until you've actually closed the position or sold the position to realize that gain. At that point, it's a realized gain, and then yes, of course, that money is yours. So that was kind of a misperception that a lot of people had. Second thing, they felt that as the stock started to go down, well, they felt, well, it really can't go much lower. Now, this is a common perception people have, especially after a big gain, that the stock really can't go much lower. That's completely false. As we know, stocks can go as low as they want. They could even go to zero. If a stock goes into bankruptcy, it could end up at zero. Now, of course, that's a rare, exceptional case, but that possibility exists. So that concept of, I don't think my stock can keep going down, well, as we saw, that's not always the case. Particularly after something runs up on a bubble. Now, finally, what were some of the other things that was sort of on the minds of traders and investors at that time? And that is that the belief that the stock would recover. Now, this is a very common thought process for people as the stock is dropping against them. They'll think, okay, well, I'll just hang in, and if the stock can just come back to where I bought it, I'll get out and I'll never touch that stock again. All right, so what are they doing? They're basing that sort of mentality on hope. Now, there's something we used to say on the trading floor, and that is that hope is not a strategy. And of course, it doesn't have any place in our trading plan for Jenny's portfolio. So we're not buying stocks on hope. Obviously, we're buying stocks with a long-term investment. And then, of course, we have some stocks we're buying maybe on the shorter term that we really want to keep tabs on them and make sure that we can put things in place to prevent a big down move. Now, selling is a little more difficult. Why is that? Why weren't people able to sell? Well, here's the thing. Selling and taking a potential loss is important because the pain that we feel when we lose money is often greater or more impactful than the pleasure or joy we get from making money. So what this does is it leads to something called loss aversion. People don't want to experience that negative emotion that goes with selling the stock and locking in a potential loss. They'd much rather experience the gain. But the problem there is it can interfere with us being disciplined or consistent in how we manage our portfolio. Now you can see Real Networks, of course, ended right back down and is at this day below $4 a share. So what are some of the things that we can actually do to help us prevent them? Well, a couple different things. We've talked about using stop loss orders, and those are points where we could pick a point that if we owned the stock and it ran up to here and we said if it gets, let's say, lower than here, we right click, and of course we can come down here and create a sell order. And our sell order, actually what we do is we would create a stop order right? So we go ahead and create a custom sell, and that would be with a stop. That would be a stop order. So that's one thing we could do. The other thing we could do is set alerts so that if a stock gets down to a certain point on the Thinkorswim software, we can set an alert just to let us know that, hey, the stock has gotten down to a point that you have decided that you want to make at least review the position and perhaps take some sort of action. That might be selling the stock or reducing some of the exposure that you have in that particular stock. So again, important things. We'll talk about these more as we go and manage Jenny's portfolio. But now you have a little bit better idea of the emotions involved in investing and how to avoid some of the potential pitfalls. All right, don't forget, for more information on these tools and other great education, visit the Education Center at tdameritrade.com. Welcome back to Virtual Trade. I'm joined by new trader Jenny Horne. Jenny, welcome back to the show.
Happy to be back, Scott.
Well, Jenny, what we're going to do is we're going to look at Thinkorswim platform and learn how to move away from emotional investing utilizing specific tools on the Thinkorswim platform.
Well, I'm excited because I think a lot of stocks I did pick emotionally in my portfolio, so I'm ready to learn some things.
All right. Well, listen, what we'll do is we'll get started on the Thinkorswim charts, and we'll pick an underlying stock, maybe something like Cisco, and see how we can use some moving averages, which are studies, to give us a little bit more of that detachment and give us some maybe some information we can pull from the charts themselves.
All right, great.
All right, well, why don't we get started, Jenny? I'll have you go ahead and take over the controls, and we'll go to the Charts tab right now and go ahead and enter the symbol, as we always do, CSCO, and hit Enter, and there we are. So we can see a chart pops up right now, Jenny. It looks like we're looking at a 1-year daily. And you can always see what your chart is by looking just below the symbol. You can see what we're looking at, a 1-year daily chart. So what we're going to do, Jenny, is add some simple moving averages. Now, we kind of looked at entering using one simple moving average. Today, we're going to take it to the next level and actually look at two and see what we can discern from the two different moving averages.
Okay, great.
All right, so let's start off by adding a study. So first step to add a study, where's your favorite place to go to do that?
Well, you showed me last time. I do like the beaker a lot.
I do
it's
too.
One step. That's
One
easy.
step. All right, so now the studies open up, and of course this is going to be simple moving average, so just type in the word simple, and there you go, moving average. Now, Jenny, what we're going to do is add two. I see you just double click to add one. Since we're going to have two simple moving averages, let's go ahead and add the second one now as well. And yeah, double click or add, that's perfect. Now apply and OK, and then we'll be good to go. Now you can see that we're showing the moving average. I think that we have one in there, but let's now go ahead and sort of customize our simple moving averages, because I know you like perhaps the thicker line and maybe some different colors. So
I definitely do.
let's go back to the beaker again and let's edit these two studies to get them set up the way we'd like. So let's click on the first one, for example, and go to the far right and click on the, there you go, the little gear icon. And this is going to go ahead and to give us what kind of line we have and what color it is, Jenny. So what's your choice there?
Well, I will make it a little thicker because I do
little
like
thicker.
when it's very obvious. So I'll make it 4 and I'll make it white.
Okay, so the first one is going to be, go ahead, all right, now hit OK, and that will save that one in that way. Now let's go to the second one, because we're going to want to have a different color on this one so we can see the difference between the two, because they will be crossing from time to time.
Right.
So same process,
I'll make
change
this
your width.
And I'll make this one this pink
Sort of
color.
a pink color? Okay, perfect. All right, now hit apply and OK, and let's see if it's showing our two averages. Now, right now, I'm going to guess those averages are pretty close to each other. Let's just make double sure on that one. Let's zoom in perhaps here to see if we're seeing both. Actually, I'm not seeing both, so let's do this. Let's go back here, make sure that they're both showing up here. Two moving averages. All right, what I'm going to do is click the second one and go back to simple. Now watch what I do here. It's S-I-M-P-L-E. And I'm going to add this, click on the simple moving average and add the moving average, and we should have two in there. All right, hit apply and OK. And as though we're seeing just one of the two simple moving averages. Let me just zoom in a little bit and make sure that we're seeing two. Now, the reason that is because right now we haven't changed.
Right, I was going to say, do you think it's beneath it?
That's exactly what it is.
The exact same thing.
So when you see things like this, that's a perfect example of saying, well, wait, we have two studies, but we're only seeing one. Well, guess what? They're both the same study. So let's do this. Let's go in and change the two settings on the two simple moving averages so that we can see them differently.
Okay.
All
So
right.
I'll go back to the beaker, I'm guessing.
Yep, absolutely. And click on the edit. Now we're going to change the first one to a 20-day. So you can see under length it says 9. We want to change that to 20.
Okay.
Perfect, and we'll hit OK. Now let's go to the second one, same way, and we'll change that one to 50. So remember, moving averages are just giving you sort of the movement on the chart on an average over whatever days we pick, or the length of the time here. And we have 20 different times on this, and now remember, each time is one chart or one bar on a daily 1-year chart. So now take a look. Let's zoom out just a little bit here and take a look now. As you can see,
Now they're different.
now they're different because we have different parameters for each. One's 20, one's 50. All right, so now we've got that all set up.
I have a question. Now, why would someone be using these to trade? Because I understand what it shows, but I don't really understand how it would help me make an investment.
Well, you're absolutely right. Many investors will use studies like the moving averages to help sort of assist them in keeping the emotions out of trading and investing. And your question is spot on. Many people ask the same thing. The hopes of using these kinds of studies on a chart are to give us a little bit of predictive nature. In other words, if we're seeing certain patterns like we're going to see here, when a moving average crosses over another moving average, what does that potentially tell us about the future direction of the stock? So obviously, for someone who's picking points to get into a stock or out of a stock,
Right.
having any kind of help in that direction by using something we call technical analysis, or studies on charts, sometimes that can help them make those decisions.
So now why would I use the 20-day or over the 50-day, or vice versa?
Ah, very good. We'll take a quick look here. As you can see that the 20-day is the white line. You can see that moves around quite a bit more than the 50-day, which is the purple line. It's a little smoother. So what we look at is the 20-day is sort of representing a shorter term movement or momentum in the stock, and the purple is representing a longer term movement in the stock. Now, we can sometimes see that the shorter move in the stock moves above and below the longer term. So it sort of gives us a little bit of idea, hey, well, for right now, at this particular time, it seems to be moving a lot more than it normally does, or it's dropping quicker than it has in the long run. So when they see these two cross over, that can give them potential signals. So let's do this. Now that we have those two, when we looked at a 1-year chart, let's take a look at any kind of particular moves that we've seen in the stock. Well, let's look at the 20-day and see where it crosses underneath the 50-day. It doesn't cross underneath by much, but you can see here it starts to cross back over, and the stock is moving up at the same time. Now, if there are certain times when you see both the short-term moving average cross above the long-term and the stock is moving up, that can be a potential signal that the stock is in an upward, or will potentially continue an upward trend. There's never a guarantee or assurance, but oftentimes it does. If we go back to the beginning of there, take a look when the first time the white line crossed over the purple line and the stock was moving higher. Look what that showed. That short-term moving average stayed above the long-term for quite a period, and look what the stock was doing during that entire time. And then when it crossed back under here, that's a little bit of a, I don't know, I would call it a red flag or a warning that maybe that long-term trend is coming into question right now.
Right, okay, that makes sense.
All right. All right, so now we've looked at sort of the short term. Let's do this, Jenny. Go ahead and let's go into the time frame and change that and look at a much bigger picture. So let's go down to, change your time there.
Okay.
And under our interval, we'll keep it, we'll go to the maximum allowed. All right, there we go. So let's go back as far as we can, and let's change our aggregate type, and that will reduce the numbers that we're having. Jenny, what I'm going to do is just hide the left side bar so we can give this chart just a little bit more real estate on our screen. Now, this is interesting. When you start taking this sort of comparison study, if you will, to a bigger frame, it can give us more of a long-term picture of what the stock is doing. So let's go back to the peak, which is back here in 2000, which was sort of the peak of the tech bubble.
Right, that makes sense.
Do you remember that?
I do, barely.
Take a look what happened here. Now, the stock had just run to new highs here, sort of in the late 1999, and look what happened right here. The stock, the short term definitely crossed over, started to move lower, and the stock was moving down at the same time. So again, we can kind of highlight this one period here, and you can see a little bit more precisely how that moved.
Right, they really moved in tandem at this time period somewhat.
Exactly. So let's say at this particular time you were wondering about, well, should I add Cisco potentially to my portfolio? And you see this just taking place. You might think, wait a minute, the short-term moving average just crossed over the long-term moving average. See how it just dove right below it? And the stock is moving down. That, like we said, might be a potential, wait a minute, maybe this is not the right time to invest. Does that make sense?
It does make sense, yeah.
Since we're building portfolios, we're always looking for potential cues as to is this a good time?
Trends to kind of follow the stocks, that makes sense.
Right. So basically what we're doing here is by using tools like this, it can potentially help you take some of the emotion out. Notice I used the word some.
Some, right, because when it is your money, I mean, it's hard not to care if you're losing or making it a lot of money.
Exactly. We can never take all the emotion out, right, Jane?
Exactly.
Okay, so what did you think about what we covered here so far?
Well, I thought this was great, and again, I never really knew a lot about charts, and I think this is another way to kind of add that level of understanding on what's going on behind the movement of the stock.
And help you potentially remove some emotion.
Exactly.
From the process. Okay, well, thanks, Jenny. That was a lot of fun, and we will see you on our next show.
Thanks, Scott.
All right. In this episode, we explored some of the most common mistakes investors make and how to avoid them. Keeping these potential mistakes in mind, new trader Jenny Horne and I continued the portfolio management process. I'm Scott Connor, and thanks for watching Virtual Trade.